5,000, a double upgrade coming in on Info Edge. Keep an eye out on this stock as a standout brokerage, but also a couple of initiating coverages that have come in on Brain Beast Solutions. You know this company better as the company that runs First Cry, a recent listing on the bourses. Issue price was close to around 465. The first one is from BofA Securities. They've initiated their target price is 770. The stock has settled 5% higher at pre-open itself. Why is that? Because they believe that First Cry is well positioned to show 21% revenue CAGR, and at the same time they can improve margins by nearly 500 basis points. What does that imply? The EBITDA would compound at over 57% for the next 3 years. And then you have the optionalities of their global businesses, which is international and global beast, which may surprise positively. We have another initiating coverage coming in from Morgan Stanley as well, and their target price is actually a shade higher than that of BofA Securities. It's 818 rupees, overweight rating. Again, a quintessential play on First Cry, which has strong distribution, large portfolio of home brands, and also supply chain capabilities. It is an underpenetrated childcare market in India itself. But, going forward, the optionalities of the international business like Global Bees, etc., can do well as well. They expect domestic business to compound at 18%, EBITDA margins improving from 9% to 13%. The childcare business can actually grow by 20% CAGR over the next couple of years, with EBITDA margins nearly doubling from 5% to closer to 10%. That stock doing well could perhaps be one of the stocks of the day.
Okay, absolutely. Yeah, those are big targets. And this is one of those IPOs that hasn't already gone absolutely berserk in a different orbit. First Cry has not had such a huge move since listing. So let's see, maybe these target prices will work well for the stock. We're counting down to the open. And in step with the rest of Asia, it is going to be a straight out gap up. 100 points gap up is what we are getting. So to kickstart things, the Nifty closing in on 25,500. There we go. We actually had 25,500 for a bit. Back above that level. So what's leading it? NTPC, the excitement around the renewables arm finally making its way as a separate listed entity. So 2% up there. IT is rebounding. LTI Mindtree, Wipro, Infosys, TCS. So the entire IT pack is undoing a lot of the damage that we saw inflicted on it yesterday. Bajaj Finance is another stock in focus, up about 1%. Some of the metal names like Tata Steel, JSW Steel, all on the upside. Coal India. So basically commodities are up. Bank Nifty is actually soaring about 0.6%. So no problems there whatsoever. Axis Bank leading from the front with a gain of about 0.7. IndusInd Bank is managing about 1%. Kotak is up in about, let's see what the big boys are doing. HDFC Bank also 0.7% higher. ICICI is a little flat, but the shade is green. And State Bank of India is managing a 0.5% up move. So no problem whatsoever. IT up, banks up. Commodities generally starting on the positive side. Just two stocks on the Nifty actually negative. One is ONGC because of the flip-flop on oil prices. Also, there are some brokerage notes this morning saying that the fall in oil is not working well for ONGC. The market's taking note of that foreign broker note. And the other is Bharti Airtel. It's kind of sitting on the fence, not doing anything. But other than that, you have 48 out of the Nifty 50 on the green side of the screen as we start off. Mangalam.
Well, the broader markets are a bright shade of green. Nearly 1,800 stocks advancing for just about 300 stocks which are declining. And that is something that the street will like in particular, because the last two trading sessions, the broader markets had seen a bit of a pain. And among the top gainers, we have Info Edge, which is the top F&O gainer this morning. And that's largely on account of that big upgrade coming in. Nimesh highlighted that in his standout brokerage note as well. The other one is United Breweries. The Andhra liquor policy actually doing well for not only United Breweries, but a lot of these other liquor companies as well. So we have Tilak Nagar Industries, which is up 5%. We have GM Breweries, which is up another 3%. And a lot of these, lower rung allied blenders, etc., lower down the order, if you look at it, past United Breweries and United Spirits, all these stocks doing extremely well too. What's also well bid in today's trading session is Midcap IT. So IT is generally making a bit of a bounce back. So you have L&T Tech Services, Birla Soft, First Source, all of them bouncing back from lows of yesterday. The other stock that is doing extremely well is Brain Beast Solutions. Two initiating coverages coming in on that stock, up around 6%. IREDA is one as well. We're back in that phase where, more supply actually is positive for the stock. IREDA, the OFS news, the street likes that. I mean, it's up 3% right now. And then these market-related plays. CDSL is up around 3%. BSE has opened on the back foot. Let's see whether that dip gets bought into or not after that big rally that we've seen on the stock in yesterday's trading session as well. And rallying for the second day running are the Reliance ADAG group stocks. So we have Reliance Infra, which is up 5%, Reliance Power as well. There were positive developments when it comes to, their balance sheet improvement in yesterday's trading session. So there was news that stock up around 5%, Reliance Power as well. So generally, way more stocks advancing than the number of stocks which are declining. The Midcap index doing well. And now, mind you, the Nifty Bank is just about 200 points away from a fresh record high. We've been seeing record highs on the Nifty, the Sensex, the Midcap index on a regular basis. That mark was eluding the Nifty Bank. And as we speak, maybe just about 100, 200 point uptick on the Nifty Bank. A slight jump on HDFC Bank could take the Nifty Bank to a fresh record high.
Yeah, absolutely. And the way the banks are charging ahead promises to be another good session. Let's see if the gains can be held on to or not, and we can get more follow through. Info Edge is really surging now. Those two, important notes that we had Nimesh highlight. It's really up and away. 9,000 was the target price that was put out. The stock's at about 8,100 now, 5% in the upside. The other one is Raymond Lifestyle. The recent carve out, the recent listing from the Raymond Group. Good day today, 5.5% up on that stock as well. And I think the market really heard our conversation with Karan Taurani on Alcobev, because United Breweries is actually the best of the pack right now, about 3.5% up. That's one of the stocks that he was relatively even more optimistic on. So looking good. The Nifty retaining a gain of 170 points, Bank Nifty up 400 points, and the mid-caps as well running right in step. Prashant, good morning today.
And I think, it's a great morning, 170 on the Nifty, and why not, right? We've got a big rate cut kicking off the global easing cycle. Remember, the thing to remember is that it's not just the reason why we spend a fair bit of time looking at the Fed and what it does, etc., is because, essentially it's, the largest, most powerful central bank, and whether we like it or not, it's got a powerful signaling effect for other central banks around the world in terms of the monetary cycle. So in that sense, it's not just the Fed kicking off the easing cycle in the US, but for other sort of markets as well. I just want to highlight one or two more names. You guys have wrapped up things. Reliance Infra is the biggest volume-led gainer. So Reliance Infra has been doing well last 2-3. I think today is the third day in a row when you're seeing action here. Stock was $210 on the 13th, and it's at 290, all 300 actually, almost 300 now. So in 3 sessions flat, and today is the third day, it's moved from 210 to 300. So, and that's got humongous volumes as well. AB Capital and HFCL and Garden Reach had some news flow. There was an order there. It's up about 3.5% as well. So, we'll come back to more stocks in a bit, but Nilesh Shah is with us now of Envision Capital. Nilesh, great to have you with us here. Thank you very much for your time. Appreciate it. So the question, Nilesh, is what to do now, right? Where to focus your energies on in trying to find opportunities. And before you answer that, if you can give us a sense whether an easing cycle will provide more impetus for even top performers like the Indian stock market. Go on, Nilesh.
I think the markets will continue to favor strength. And from a global perspective, clearly India has been the strongest bastion and has been the strongest kind of island, if you may call that, from a global investment landscape. And with this environment of aggressive rate cuts, that should only augur well for a market like India and an economy like India. The reality is that global international investors, foreign investors have been underweight India. India's weight in various market indices has been kind of galloping ahead, and they have not yet been able to catch up with that. So clearly, I think an environment of rate cuts, cost of capital coming down, I think that should essentially trigger them to kind of allocate more to India. So I clearly believe that while global growth could be a concern, specifically growth in the US, and that's what I think the US Fed has highlighted in terms of jobs. So that will be a headwind, but clearly for India, this headwind could actually end up being a very, very strong tailwind. So that plus the strong domestic liquidity are something which will continue to favor Indian market. So to that extent, I think while conventionally a rate cut cycle has not necessarily resulted in a good equity market, But probably this time around, India is probably going to kind of keep behaving differently the way it has over the last couple of years. So to that extent, I think this bodes and augurs well for India.
So what sectors do well, Nilesh, and where will you look for opportunities? Will you look at something which you were not looking so far? Let's put it that way. We know some color on what you own and what you like from our previous discussions, but would you look at something which you were not looking at so far and now you'd want to because of what has happened?
I don't think the investment strategy or the style is going to change materially with this development, Prashant. I clearly believe that the two most powerful themes from an India point of view, which are very long-term structural in nature, are around urbanization and digitization. These two are essentially the most powerful structural multi-year kind of trends, and these continue to be favorites. I clearly believe that digitization still, I think, is being undermined. I think most investors are kind of having a chorus around valuations, but clearly believe that growth and the upside from a business point of view is far going to outweigh the near-term valuations. And I clearly believe that investors are still significantly underweight on digitization-oriented opportunities, online businesses, consumer, fintech, and they will continue to positively surprise for several years. Yes, sure, there will be one or two intermittent quarters where they could have some kind of a patchy performance, but otherwise I clearly believe that that remains the most powerful thing. Similarly, consumer discretionary, I think that's again going to continue to do well. Prashant, also the last 2 or 3 years, a very large part of the government's allocation has gone towards infrastructure. That continues to be north of 3% of the GDP. But in addition to that, what we have seen in recent months is essentially a lot of cash transfers which are going to happen at the state government levels. And these are humongous amounts. I mean, individual states allocating 20, 30, 40,000 crores as cash transfers. That essentially is going to rev up the entire consumption space as well. And several discretionary products are going to essentially enjoy strong tailwind. So I clearly believe that while we so far over the last 2 or 3 years have been seeing one side of the market perform, which is the capex infrastructure-oriented place, but I think going forward with falling commodity prices, falling input prices, falling interest rates, and these cash transfers are going to provide massive tailwinds for the consumer-oriented businesses.
All right, Nilesh, you speak about digitization. And can't talk enough about how big that opportunity is. We have InfoEdge, which is doing extremely well. Brokerages are positive on that. Zomato, we've seen a massive run that has happened. And this morning, there were a couple of notes coming in on First Cry as well. But we can't, have you and not talk about the IT pack, because yesterday it was under a lot of pressure. Now it's seeing a bit of a bounce back. From the lows, generally, the IT index has seen a rally of nearly 30% as well. How do you look at the US economy and Indian IT stocks in conjunction to that?
So Mangalam, I think the entire US economy, I think, is going to go through headwinds for some time. And that honestly doesn't augur well for the big conventional IT services companies. So I clearly believe that that's really not the space to be in. But there are several tier 2, tier 3 IT services companies which are having niche offerings around products, around services. Some of them have built strong AI capabilities, and they will be able to grow at a substantially higher pace versus the bigger ones in the peer group. So I probably think that this rally should be probably utilized to continuously switch from the large cap IT names, the top 3, 4, 5 names, and move over to specialized tier 2, tier 3, mid cap, small cap IT services and IT product companies. And that probably is the space to continue to be in.
Okay, mid cap IT companies and fintech, consumer tech, the other aspects of technology beyond traditional IT services. Got that, Nilesh. Good listening into you. So, beyond this, I think the other question that people are grappling with is whether the leadership change away from capex, from manufacturing, from that entire side of the market, PSUs, whether that indeed is now well entrenched, if it's truly underway. What would you say? If someone's still holding on to those positions, is it time to book profits? Should you stay away, or should you look at buying the dip? I mean, where do we stand on that entire, massive move that we saw for the last 2 years?
that space surely deserves a much lower weight or a lower allocation. I think if somebody's kind of been there 3 years ago, 2 years ago, or maybe even a year ago, it might actually be a good time to kind of take some money off the table, especially in the conventional defense names or some of these other infra-oriented spaces. And clearly, I think move towards more of the consumer, the online, the financials. I mean, banks have been a big pocket of underperformance. That might be a good space. NBFCs, HFCs, these are the kind of places where incremental capital allocation ought to be done. In addition to that, even within the overall capex infra space, maybe the ones which are more veered towards the manufacturing side, the semiconductor side, these are probably the kind of areas where one should kind of veer more towards rather than the conventional capex name. So clearly, I think this is an environment which really will call for some tweaks in portfolio strategy. It will call for some kind of reallocation in terms of sectors. So clearly, I think it's time to kind of be a slightly cautious on the capex cycle, on the defense cycle, not because these businesses may not do as well. These businesses will do well, but just that the valuations have gone up so much that they factor in much, much higher growth, which I think may not be possible. They'd probably still grow at 10, 15, 20%, but they essentially will not grow at the kind of pace at which they have been growing over the last 3 years.
What else are you cautious on? Nilesh, what else are you cautious on?
I think that I kind of earlier talked about the large cap IT. I think that space calls for caution. Clearly, again, for commodities, this is a difficult time for commodities. It will be a difficult time, especially if global growth slows down. Demand, I think, is going to be challenging. There could continue to be more softness in terms of commodity prices. So I think one should be very careful even with the typical commodity and the cyclical space. Obviously, users, consumers of commodities will do very well as they essentially will have lower input prices, which could obviously bolster their margins. So clearly, I think avoid producers of commodities and basically kind of be more towards the consumers of commodities.
Nilesh, finally, to wrap things up, I mean, back to a market question, really. And I was just thinking that the last time we got into a US rate cut cycle, I mean, the big ones, let's go back to 2008-9. It was basically in response to a massive crisis, right? Markets had collapsed, and then the rate cuts kicked in, and then 2009-10 onwards, we started getting the market rally. Ditto for COVID. The market fell, there was fear, then the US Fed started cutting rates, and then the market rallied. This time, the difference is that we've gone into the rate cut cycle on a song, on a dance, right? Markets are at all-time highs, whether it's the Dow, whether it's India, NASDAQ, whatever you look at. So in that sense, can the party just keep continuing? Or do you think that there's some risk out there that we've perhaps missed?
The party, I believe, will continue. At least I can say that the India party looks pretty good. We surely have higher growth, we have moderate inflation, and we have stronger liquidity back home. So I think the India party will continue. Just that when these global headwinds, which have started to kind of surface, or you could probably say resurface, there would be breaks in between to this party, and that break could probably be shorter, but could kind of be steep as well. So I wouldn't rule out at any point of time maybe a 5 to 10% correction in the market indices and maybe more correction in individual stock prices. That I think is quite possible, and that's like par for the course, especially if you're essentially looking at a slightly more medium to long-term perspective. So clearly, I think yes, and historically, every year we do have situations where markets during the year correct 10 to 15%. So that possibility can never be ruled out. But clearly don't believe that the India party is over. The India party is essentially still kind of has way more to go before we can say that, we are done with the bull market.
All right, Nilesh, thank you so much for joining in. Always a pleasure speaking with you. India party is likely to continue, far from over. On that optimistic note, we'll take your leave with the news that the market still continues to hold on to its initial gains. The Nifty Bank actually was very, very close to its record high as well, went just within 4 points from that record high before cooling off a little bit. So we'll keep an eye out on how the market pans out, especially in the second half of trade. And as we speak, we'll also, very shortly get all those doyens up on your screen for you in conversation. So it's the JP Morgan India Investor Summit that we will talk about. We'll have Sajid Chinoy, Sanjay Mukim, Kaustubh Kulkarni, all of them talking to us as well about their view on where the Indian markets are and what's the expectation as well. Let's cut across to Lata, who's now in conversation with the JP Morgan Brain Trust ahead of the all-important investor conference on a day where the markets are at a record high. Over to you, Lata.
The Fed has delivered a supersized cut, and EM central bankers, like the Reserve Bank, will now have to face up to a 4.4% Fed funds rate by year-end and as low as 3.4% by end of 2025. So will dollars rush to emerging markets because you earn less on US bonds? Will the Reserve Bank have to cut rates to avert a rupee depreciation? The FOMC has also, remember, lowered the US growth forecast just marginally from 2.1 to 2% for the current year. It has upped the unemployment forecast to 4.4% from 4%. This will mean a slowdown in global growth, or will it? Then which stocks would be best bets for an Indian investor? For a 360-degree perspective on the Indian and global markets and macros, I have with me the JP Morgan Brain Trust. Sajid Chinoy, the economist, Sanjay Mukim, the head of equities and research, and Kaustubh Kulkarni, the head of country head in India. They've all been kind enough to come over ahead of their all-important investor conference on Monday. And so here's trying to get everything that foreign investors think about us. But first, Sajid, first things first, the Fed cut. What does this mean? Now is a Reserve Bank rate cut imminent in 2024?
So first, let's talk about the Fed cut. And, our US team had called for a 50 basis point cut, so this is not a surprise. I think what matters more than the quantum of whether this was 25 or 50 is why is the Fed cutting? Is the Fed cutting because the US is on the cusp of a recession? And our answer is no. In fact, if you look at the Fed Atlanta's nowcast, growth in the third quarter in the US is tracking 3%. The consumer is extremely solid. So the Fed moved because the balance of risk has now changed. They're much more comfortable that inflation is heading towards 2%, and they're a little bit concerned that the labor market has begun to soften. If you look at their own Taylor rule, right, about where rates should be, given this mix of unemployment and inflation, it should be at 3%, 3.5%. So there was this 250 basis point level shift that they had to undertake, and that's the way to understand this 50 basis point cut, that we may see more of it if the labor market slows in the coming months. Don't rule out another 50 in November if the labor market slows. But the point is that rates are now much above where conditions on the ground in terms of growth, inflation, the labor market are. The important part is the US is not slipping into recession just as yet. So they're cutting, in a sense, from a position of strength. This was a happy cut because inflation is coming off faster than they actually thought. What does this mean for emerging market central banks? Lata, there are going to be a lot of idiosyncratic factors. We should not rush to
India.
First, India. Well, let me just lay the backdrop by saying Brazil hiked yesterday by 25. Bank Indonesia cut by 25 even before the Fed. So a lot of idiosyncratic factors will matter for emerging markets. I think for the RBI, again, the news is incrementally positive, that despite a slight upside surprise to CPI last month, despite the fact that September CPI could bounce back to 4.8 or 4.9, there's more conviction now with every passing week and every passing month that food inflation is going to gap down. We've had a strong monsoon. It looks like a good sowing season. Global
so
food
for
prices
domestic
are benign.
reasons, you're saying?
So, but I do think the RBI will want to see a little bit more data. So we actually think in October they'll still hold their gunpowder. They'll want a little bit more conviction that, yes, food inflation after 3 years of being sticky is finally going down. And as the governor keeps saying, it's not about being at 4% for a month. It's about durably seeing 4% for the next few quarters. But this does, I'll end by saying, if the Fed cutting this year increases the odds of a soft landing in the US, that's a very good global environment for risk assets and emerging markets in 2025.
Our viewers are dying to hear what it does to Indian stocks. But very quickly, would you believe that there is still a global cloud on Indian growth? The domestic factors are pro-growth,
Yes.
but there is a global slowdown?
No question that, yes, the US is holding up, but look at the other parts of the world. There's been a lot of US exceptionalism. Europe has been soft. China continues to soften. So global growth is going to soften. And as we saw in the latest trade report, we won't get the same tailwind from exports that we have been getting over much of the last 2 years.
Okay. Well, with that, let's come to the area where we are, immediately interested in stocks. Sanjay, I read your report on how India is in a late cycle of the business cycle. First, just explain to us before I bring the Fed in.
Well, look, we've seen for the last few years in India very strong stimulus support, very strong economic growth, upgrades which are rare in India to earnings estimates and companies beating forecasts. That seems to have faded away, Lata. Right? And in
the first quarter saw downgrades.
That's right. And a significant number of downgrades, which actually is very rare for 1Q. We normally see downgrades in 3Q and 4Q towards the end of the year, but we've actually seen misses and downgrades in 1Q. We've also seen the downgrades to the GDP number, for example, as well. And that's one of the reasons we're talking about slightly late cycle dynamics in equity markets. Of course, we've stopped talking about valuations because, that signal has been flashing red for 2 years now. But in terms of growth, in terms of outcomes of companies, earnings momentum also, it does appear that we are more than through a significant upcycle in the equities market, at least.
Okay, so therefore, is it avoid equities or is it some kind of equities?
Well, that's a bit hard.
What would your preferences?
Right, so it's difficult to say avoid equities entirely because, of course, let's say if you're a local investor, Lata, this is one of the challenges.
Yeah, else will I put my money?
Exactly, right. With the tax incentives that we have in the economy, equities still appear relatively decent on an expected return basis, right? And it's difficult, therefore, to say you sell everything and leave the market. It's the only thing that we argue is that a lot of corners of the market are propped up principally on liquidity. And when things turn, it is that liquidity that presents a risk. See, the one thing that people forget at the top of every bubble, and we don't know when it will be, is liquidity, right? Bubbles burst because of liquidity issues. And therefore, our advice to investors is that in all of your participation, be cognizant of quality risks, right? Do not compromise on having...
Quality.
Exactly, right. We can't...
So you're never left holding a lemon.
Exactly, because when the tide turns and you should not be unable to get out of your stock.
No, but what is a typical late cycle stock that does well? If you're in the late cycle, obviously the big growth areas, consumption should not do well. What should do well?
Well, as of now, we are overweight consumption, Lata. Okay. And this is because we've...
Both durables and FMCG?
More durables, more FMCG, I beg your pardon, for now. And this is because we expect, the K-shaped recovery that, we've had post-COVID to converge a little bit. We're starting to see a little bit of signs of it. It's still very early to kind of convincingly argue it, but there is hope that this might happen. So we are actually overweight the staple stocks.
And what else?
We like real estate, for example. We think the momentum, again, going back to the argument, where else will you put your money? The equity market benefits from it. The real estate market should also benefit from it. We are overweight healthcare. We also like, so we are not very keen, let's say, on the IT and material space as of now.
No, I would assume healthcare is a late cycle preference. It's a defensive.
It is.
I want to come back on whether the K is converging, even slightly. But before that, Kaustubh, the big point is that FIIs are not flowing into Indian equities as much as they're even flowing into Indian debt. When you look at the data around, quite a few GEM funds are, not up to the weight they should be, rather underweight India's, weightage in, for instance, MSCI. What's your sense about how they will behave now? Do you expect that now, with the dollar also weakening, will there be a FOMO and they rush in?
I think it's true that relative to the MSCI weightage that India has, FII ownership is still, at least depending on the day, 2 to 3% lower than what it should be. But a big reason for that is the weights for India have increased meaningfully compared to where they were 3 years ago. Two, Indian market and FII, a number of the largest FIIs understanding in the Indian market was reasonably limited to around 75 to 100 of the larger liquid stocks, as Sanjay mentioned. Whereas, as we know in India in the last 3 to 4 years in particular, the breadth of the market and number of companies which have created excess returns is way, way larger than just the 75 or 100 companies. FIIs, therefore, have to go through their own recalibration and understanding of the market in India. once they're able to do that, and that's where we are seeing so much more interest from FIs to understand exactly what's happening. Because of the change in weightage, they have to do more work, but equally they have to do a lot more work in terms of the complexity and the breadth of the stocks that they have to start covering. We think they are doing active work, and hopefully, I think, therefore, the money will follow once they finish the work.
Okay, I want to come to Sanjay on the stock preferences. Aren't FIs put off by the valuations? I mean, at least in the mid cap, do you ever see them broadening beyond the large caps?
Well, to a large extent, they have. If you look at data across Asia, Lata, the largest off-benchmark exposure for foreign investors is in India. Right? Whereas in other countries, foreign investors may not even own the entire index constituents. In India, they own a far broader. It's still not a very big divergence, but at least within India, the foreign exposure off benchmark is reasonably high. Are we starting to see interest? We do get questions from people about, hey, what's going on in this part of the market, etc. But the one sort of feedback, if I may, people are generally cognizant about valuation issues, right? And they don't want to be, like I said, be caught buying the top. And especially when
that is a deterrent.
There is a deterrent. Okay. Especially when you contrast Indian valuations to similar sectors, similar countries elsewhere, the divergence looks very stark at the moment. So I do get this resistance saying, hey, look, I'm okay with the set of stocks I have in India for now. I really can't make up my mind and convince myself to buy anything.
I want to put the incremental money. But what about large banks? I mean, Sajid is saying that if not a rate cut in October, it's somewhere there in the horizon. What does that do to your view of financials?
Well, I think most foreign investors, of course, have a decent exposure to financials already, right? And this is a legacy exposure. It's a macro view, take an economy to just go buy a set of banks in the country. That's how it's played out for many years now. And what we're seeing, of course, is banks are best placed on the valuation filter, Lata, but on the growth momentum, naturally, there has been a significant slowdown, right? In the terms of the YOY growth that you got in 22 and 23, the growth we are now getting out of banks is much more meager. So the debate you have in the investment sort of ranking, this looks great on valuation, but the growth number is perhaps no longer as exciting as it used to be. Now, our pushback is, look, relative to growth valuation or a PEG ratio.
So, may prefer NBFC in that case, no?
Yes, but NBFCs can be far more cyclical.
Okay.
Right. You have to take a cycle view, sector view, rate view, for example.
Fair enough. I have more questions on the rate view as well and what it does to bank margins. As well, this very interesting point to make about whether the K is not widening, but probably lessening, and more important, dollar. Dollar and dollar rupee. Where is it headed? All those questions to the JPM Brain Trust after the break.
Welcome back. There was some interesting conversation with the JP Morgan Brains Trust. The market continues to hold on, scale newer heights right now. While we are talking about the Nifty hitting that 25,500 mark for the first time, it's also the Midcap index which hit that 60,000 mark for the first time. So a big milestone that we have on the Midcap index, though it's cooled off a tad, and that is understandable as well. Just pull up the crisscross lines, the intraday crisscross lines. You'd see them coming slightly closer. At the open, we had 1,700 stocks advancing. for about 300 stocks which were declining. Now the number of stocks that are declining have tripled. So it's come to close to around 900, whereas the number of stocks which are advancing have come down from 1700 to around 1400 as well. So this is a trend that we'll keep an eye out on as we move towards the second half of trade and expiry, the Nifty weekly options expiry in particular as well. But more market and investment talk lined up for you. We have Anand Shah, who's the head PMS and AIF investments at ICICI Pru AMC, joining in. Anand, always a pleasure speaking with you. With the overnight Fed rate cut that has happened, what's your view on markets in general, the sectors that are likely to do well, and something that you're cautious about post yesterday?
Hi, very good morning. Thanks for having me. So I think what it does, what the rate cut does is actually it removes one overhang in the market in terms of that was one uncertainty, because very clearly, if you see, Indian economy has been okayish, but the headwinds were more from, say, China slowdown or a US rate hike, dollar strengthening, and so on and so forth. So I think this, in a way, removes one overhang that what if the dollar, the interest rates in US continues to remain high and the dollar continues to remain strong. So I think that will give little bit of respite. Nevertheless, the verdict is not yet out. If you see the response of markets post the Fed cut is also not very strong, given that the commentary is not as per the expectation, and to that extent, the subsequent cuts will be more data dependent. Coming back to India, I think India, the divergence in the various sectors in terms of performance has been very high for last 4 years. We had consumer-facing businesses sort of underperforming, IT underperforming, and the core sectors, manufacturing allied, they were doing extremely well. Now we have reached a point where most of the stocks that were to be discovered, most of the sectors that to be discovered have been sort of researched and discovered, and to that extent, the broad moves in the market would be smaller and smaller. The market cannot really move exceptionally fast and high in a short periods of time, but it will be more stock specific. So what we've been telling our advisors, our investors, and even my own team, that from here on the market, within the sector also will have winners and losers. And within obviously the broader market, there will be more stock picking opportunities, which we'll have to pursue rather than the macro ideas.
Yeah, absolutely. Take that point, Anand. Hi, great to have you with us this morning. And from what I recall, across a lot of your strategies, there was a fair amount of exposure to the whole manufacturing theme, right? And now the market seems to be in a mood to kind of churn portfolios, if I could say. There's some buying in banks, obviously interest coming back in IT. So in this environment, within that manufacturing theme, what would you still hold on to, and where would you say the time has come to maybe take some money off the table? If you could explain it in a little more granular way.
No, indeed. I think we've been, overweight banking in general, which has not really played out in last 6 months. It's been only last 1 week, 2 weeks that there's some excitement in banking, but banking remains a pick where the risk reward is fairly favorable, because you have a large cap, liquid names with good quality of earnings, more stability, and to that extent, that offers you a good opportunity. Within the manufacturing, the one area which has sort of suffered the most from China's slowdown has been metals. That one area has been under serious stress in terms of profitability. The prices are coming off, and within that, the Indian metal companies have repaired their balance sheets over the last 4 years. They've been more ready for, stress on the pricing more than they were in 2020 or before. And to that extent, that metals within the overall manufacturing space is something which can look at bottom up and identify businesses which can withstand this slowdown and then benefit as the metal prices recover. Auto ancillaries remain strong in terms of opportunity, not only within India, but outside India. Many of the auto ancillaries over the last decade have sort of diversified their customer base much better than where they were 10 years back. And to that extent, they also do. But again, as I said, it's more bottom up than the top down.
Yeah, no, take that point. But, you know, on auto ancillaries, just yesterday we were speaking to one of the companies, Suprajit, and discussing what the slowdown in the West means, because a lot of these auto ang players, they have a lot of exposure to the Western markets where sales have been coming off. Does that bother you, and how are you reading the export part of the ancillary play?
Indeed, that has been a pain for last almost 12 to 18 months. Especially the Europe has been not really doing well for many of these guys, and that's been reflected in the numbers, reflected in the stock price. So many of the auto angs and even the bearing companies which have exposure to Europe have underperformed a lot. So both metals and auto angs, as I said, have suffered, but any recovery in US, any stability in Europe can incrementally help them. And as I said, many of these businesses were much more vulnerable to a slowdown, say 4 years back, 5 years back, that the debt levels were high, utilizations are low. Today, many of them have repaired their balance sheet. They can withstand this slowdown, and genuinely last 18 months they have withstood this overall slowdown very well compared to what was the situation a decade. So overall, bottom-up ideas in manufacturing where people have now stronger balance sheets and more diversified customer base
is where you need to be. By the way, I should just point out that the color is changing in the market, especially the mid-cap screen. Look at this. We've got red on mid-cap. So the sense of caution is very much prevalent even here in India. It wasn't just the volatility in the US market. See that changing very, very quickly. Where's the money coming off? Quite a few of the PSU stocks, by the way. RVNL, IRFC, PFC, IOB, REC, Central Bank of India, you get the drift. So PSUs is where the money is coming off. And some of the other names like, the more active names like an IRB, Infra, NIIT, some red on these stocks as well.
Well, there was a mild dip in gold as well overnight, and as a result of which we've seen some of the stocks which have higher exposure to unhedged gold coming off too. So PN Gadgil, for instance, down 5% now, had a stellar listing in the earlier part of the week. And then we have BSE as well, a big mover in yesterday's trading session, now seeing a sharp bout of profit, taking down about 6%. So negating, a large part of yesterday's up move that happened as well. But back to Anand, one of the stocks which has been in focus today among the top gainers is NTPC. The street was expecting value unlocking through its renewable, subsidiary, and that's something that is happening. You hold this stock. I mean, how much of it is in the price right now?
No, so again, stock specific is difficult, but overall, look, last couple of months have been tough, especially with good monsoons. Electricity demand has sort of softened. And to that extent, generally the segment where we were looking forward to a significant deficit of power, and to that extent, we had strong up move in across the power sector, both generation, distribution, and T&D. We have seen some softening there, but our take is that given that manufacturing is picking up, given even the electricity penetration will go up and the consumption of electricity at the household level will go up, we remain constructive on the power segment as a whole, generation, distribution, as well as T&D.
Okay, Anand, we'll leave it there. Thank you very much for your time. Pleasure speaking with you here on CNBC-TV18 this important morning. So that's essentially what we have as far as the market view is concerned. By the way, I have to say that, and Surabhi was pointing out the mid-cap space, overall market breadth has also flipped into the negative. I mean, this is overall NSE. You've got about 1,250 stocks down now, and you've got about 1,140 stocks which are higher at this point. And the biggest loser is Bajaj Housing. The biggest volume-led loser is Bajaj Housing, is down 7%. Stocks are about 161 at this point in time. And you've got BSE, of course, which had a one-way kind of a move. At the highs, recent highs, BSE's market cap had reached almost about 20% of NSE's implied market cap at about 5,500 rupees a share. Ola Electric, recent listing, and of course, there were two initiations. Stock went up day before, 3% lower here. Nazara is down sharply, 4.5%. That fundraise yesterday, 1,040. So yeah, I mean, it's kind of more and more into the mix as we sort of finish and we get closer to the first hour mark as far as markets are concerned. Well, you know, we've been talking about rates in the US and how perhaps the Fed has kicked off a global easing cycle. Let's bring it down to India and get a perspective on, you know, what we should expect on rates here in India, and of course what the impact on financials really is. Remember, the neutral rate in India is estimated to be between 1.5% to 2% odd. RBI's target inflation is 4%, and RBI is not expected to start to cut rates. I mean, is expected to start to cut rates only by about December of this year, maybe a few 25 basis points from that point on. We have the former RBI Deputy Governor, Mr. S.S. Mundra, is joining us. We have Param Subramaniam, Vice President, Equity Research, Banks and Financials. He's with Nomura. Gentlemen, great to have both of you here. Thank you very much for your time. Mr. Mundra, if I can start with you. So, you know, the Fed's cut, when do we start to see the cut here in India? And in your experience, I mean, is this a big global easing cycle on the downside? How does it typically play out? Go
on. Thanks for having me here. If I look at it, actually, 50 basis point cut has come as a surprise, little bit of surprise. But if we look at the US scenario, I think all the forecasters were expecting a 25 basis point cut. But market were already probably building in a 50 basis point cut. That was the scenario before the Fed meeting. Now, with this 50 basis point cut, probably what Fed is signaling that maybe they are comfortable with the trajectory of inflation. They are also factoring in the fact that while inflation is at 2.5%, but there would be lag impact, and it will be on course. And probably focus is on now employment and growth. Interestingly, the expectation, the forecast of a recession in the US has significantly increased in last 1 month. I think from almost 50% to 61%, and that is the trigger. But there is an interesting point between the India and the US. While in India, the consumer inflation is well on lower trajectory, but the core inflation is stubborn. In India, the situation is exactly reverse. The consumer inflation is stubborn, while the core inflation, in fact, part of it has even moved into the deflationary category. Anyway, my view is, or I would say, expectation would be, desire would be that probably RBI now would move with a 25 basis point cut in its next policy announcement. There had already been a significant divergence of view in the MPC. Of course, we would have a new MPC, new members, but I would expect that this 25 basis point cut, where the RBI would also factor in that there will be some lag impact. If you read the inflation reading in the nearest month, that is the July and August, it is already below 4%. Of course, RBI will take a longer view, would like to look how the trajectory is in next 6 to 12 months. But I think looking to the overall environment, looking to the Fed action and looking to the data point, which is emerging within India, also slow down in both consumer-facing activities as well as the investment-facing activities.
Right.
There is a sign of some slowdown. Probably a 25 basis point cut would be a thing to go for.
Okay, got it. Thanks for sort of putting it clearly, Mr. Mundra. Param, if I can come to you. Good morning, Prashant here. What's the impact on financials here in India? If you can go segment by segment. Sure. Are there any plays here from a stock perspective? Go on.
Yeah, sure. Thanks, Prashant. Good morning to all your viewers. So yes, from a rate cutting perspective, if you look at it for the banks from a margin perspective, remember in this cycle, it's different from previous rate cutting cycles because banks have a large portion of their loan books directly exposed to external benchmarks. And so when the rate cuts do happen, there is a negative pressure that will come through on bank margins as well as their ROAs. The rough math we have is that about a 50 basis point rate cut by the RBI will translate to about a 15 to 20 basis point negative impact for the large private bank margins. At an ROA level, it probably comes down to something like 7 to 10 basis points, right? Some of the smaller banks, mid-cap banks that have higher fixed rate exposures, they have a lower, say, negative impact on their margins and their ROAs. But you also have to take into account the fact that some of these smaller banks also have exposure to riskier segments, be it microfinance, be it personal loans that have been in focus from, say, an NPA perspective for the sector as a whole. Now that's the first order impact. From a second order perspective, you also have to take into account that rate cuts generally do bring in easier liquidity, and that has been one of the constraints for the sector as a whole. So when you have, say, an easing money supply, that will also help the banking sector from a growth perspective as well. And generally, in 2 out of the 3 last rate cutting cycles, we've actually seen CASA ratios for the sector as a whole also improve. Now we've seen sharp deterioration in the CASA profiles across the banks over the last 2 years. But at the margin, if you are moving into an accommodative phase, one would expect that you don't need to be very negative on this front. From a positioning perspective, we are more towards the large private banks at this stage. So the names we like are names like Kotak Bank, ICICI, among the large privates. We also like SBI among the PSUs, and within the mid caps we like a federal bank. We don't see a need to move down the risk curve. Of course, there is a margin level pressure, but to play that, we don't see a need to move down the risk curve as the sector as a whole is pretty cheap, from a historical valuation standpoint.
Well, Param, quickly, do NBFCs, because the liability side has been the problem for a lot of NBFCs, liquidity has been tight, larger ones can raise, go overseas, etc., smaller guys cannot. Do you think, from an investor perspective, NBFCs and some of the smaller ones stand to benefit as well?
Yes, of course. So the NBFCs are natural beneficiaries. And the way we would look at it is to look at NBFCs that don't have problems, at least from a credit cost or NPA formation perspective. And from that standpoint, we are more in favor of some of the secured NBFCs, which will have the margin benefit tailwind as well as the liquidity easing tailwind, but not as much of the credit cost pressure. And from that perspective, the names we like are names like Shriram Finance. Within the affordable housing space, Aadhar Housing is something our analyst likes. And we also like a small SME focused lender called 5-Star. So I think that's the way to look at it. Secured NBFCs is of course a key beneficiary. Yeah.
Okay, got that, Param. I'll stay on some more questions in a bit. Mr. Mundra, if I could come back to you, sir. You said that in all probability, maybe we'll see 25 basis points from the Reserve Bank of India. But let me ask a wider, broader question. Apart from the fact that one of the biggest central banks in the world is now on a cutting cycle, does the RBI really have any reason to move on rates at all? Because inflation, consumer inflation, like you rightly pointed out, sir, is very, very sticky. And the governor has been always in his commentary mentioning that there's a hawk eye on inflation and we can't sort of, lift the foot off the pedal there. And on the other side, growth is not really faltering in India. So is there a need to move on rates at all? The RBI could perhaps look at liquidity measures instead of rates, could it not?
No, you are very right. And probably that is why I say my desire would be, I never said that RBI would cut. That was not an emphatic statement. I said my desire would be that there should be a cut. No, the point is, as I mentioned, in the recent month, the inflation reading is below 4%, while growth is strong. But if you again look from the recent month, both on the consumer-facing business as well as the investment-facing businesses, there had been a slowdown. So I think while growth is continue to be good, but it continue to remain below potential. So I think that is where the tipping point is, and that is why I said that probably now there is a room, because if with US 50 basis point cut and India remaining where it is, I think the RBI would have to face another problem, is a tricky part. And that would be probably the inflows coming, rupee appreciating, which can create problem for the export sector, which had already seen, some discomfort in the recent months. So I think this is where the, balancing factor is there. And that is why I said probably RBI and within MPC also, there is a divergence of view now for quite some time. So maybe probably this time RBI may prefer to start a cycle or at least giving a signal. Of course, it could be either a rate cut or it could be, as you rightly said, there could be liquidity measures, there could be some other indication or even the stance may change. But some action would certainly emerge. This 50 basis point cut by Fed cannot be completely go unnoticed in the RBI's policy announcement. That is my point.
That's a fair point. Thank you so much for laying down the thought process of the RBI, what your desire is and what the expectations are from the street as well. Mr. Mundra, Param also talking about the stocks that you like and the sector which is little, still has some value on offer as well. Insightful discussion this. What we'll do is take a short break with the news that the Midcap index sell-off is now exacerbated, down almost 2/3%. And the advanced decline has flipped completely. 1,500 stocks declining for just about 900 stocks which are advancing. A lot of stocks seeing a firm amount of sell-off, though no problems for the Nifty Bank, which still holds its head above that 53,000 mark. We'll keep an eye out on the markets and a lot of individual stocks and the commodity space as well after this short break. Welcome back. Even as the Midcap index is seeing some sell-off, a couple of stocks doing extremely well. Gillette is the one that stands out, has moved to the high point of trade, and that's largely on account of positive commentary coming in from its analyst meet yesterday. The street likes the prospects of growth, and their market share in the grooming segment has been the highest ever in 2024 itself. But that's about the equity markets. Let's talk about the commodities market. Manisha, after what took place overnight by the Fed, what's the commodity that you're tracking today?
Well, I'm looking at the whole gamut, by the way. There was a knee-jerk reaction as soon as the 50 basis point rate cut came in. And that is because the commodity markets, well, they trade for 22 hours in a day, somewhere across the globe. And we saw immediate reaction come in for this one. So $2,600 an ounce is what the gold price is. Immediately gave you on screen after that. But since then, it has been a bit of a profit taking into the markets. And that is because the dollar index and the bond yields also gained up. This this is after the U.S. Fed future guidance, where Jerome Powell said that the Fed is not in a rush to continue to ease policy, and 50 basis points is not going to become a norm there. 25 basis points in the next two meetings is what the street is now working with, and that is something that the gold as a commodity or a wealth has already factored in. But what really seems to be working right now is that we already have seen ECB cut interest rates, Hong Kong cut interest rates by 50 basis points, and now the street will watch out for Bank of England and Bank of Japan monetary policy meeting in this week itself. So if you have this continued global cycle rate cut continuing, that could bring support back in case of gold prices. Western part of the world is looking at a lot of gold buying in physical sense, bonds and ETFs as well. If you look at the global ETF market itself, for the last 3 and 4 months, we've seen net inflows come into the space. Also, the net longs on COMEX gold are at the highest since 4 years. So that tells you that the long ads have just about continued, and any profit taking that we've seen in case of gold hasn't been more than $50 or $70, and that's exactly what we already have seen since the market went up. Industrial commodities as well have seen that knee-jerk reaction after the rate cut. But since then, in the New York session itself and the Asian markets right now, we have seen a bit of a decline. A 50 basis rate cut also tells you that the US perhaps is concerned about a slowing economy. Also, the kind of data that we have seen come in from China has all been on the weaker side. Unemployment numbers, retail sales, production, fixed assets, home prices, everything has seen a decline. So the street believes that going forward, perhaps China could come out with more stimulus measures, and that would be supportive. But at this point in time, we haven't seen all of that work. So crude oil prices also have seen a decline, while it is still trading at around $73. But remember, crude has seen a decline of 13% already in this quarter. And we also have seen the US crude inventories surge to by nearly 1.6 million barrels as the data came in yesterday, and that is weighing on. Within the metal space, zinc, copper fell by 1% overnight. If you look at aluminum, tin, they fell by 0.5% as well. So the only thing that the street will watch out now is if there is a China stimulus coming, and what will Bank of England and Bank of Japan do now in this week.
All right, take that point, Manisha. Thanks a lot for that. From the Fed, it's over to the Bank of England and Bank of Japan. The impact of that on the commodities as well. We take a short break on that. On the other side, as always, our special segment, It's the Economy. Lata will get chatting with Chetan Iyer, Chief Asia Economist, Morgan Stanley, to decode India's growth picture. Stay tuned for that one.
Welcome to It's the Economy. It is an important day for the global economy. The Fed has delivered a supersized 50 bips rate cut, and you can see the celebration across Asian equity markets and even currency markets. The dollar is on the back foot versus quite a few currencies. And of course, equities both on the Nikkei, on India, on several markets are celebrating. What does this really mean for Asia? Does it give all the central banks a little more elbow room to cut rates so that they can stimulate their own economies, especially a beleaguered economy like China? Also, a growing economy like India, does it get more stimulus For all these questions, I have with me perhaps one of the best observers of the Indian economy, Chetan Ahia, the Chief Asia Economist at Morgan Stanley. Chetan, good morning, and thank you very much for sparing time on what must be a very busy morning for you as well.
Thank you for having me, Lata.
Well, for starters, this rate cut, what does this do to the Reserve Bank itself? We're already seeing food inflation dipping. Do you think it gives RBI an elbow room to cut?
Well, I think if the RBI goes by the framework that they have laid out, which is that they want to see 4% sustainable inflation on headline basis, at this point of time, we still think that RBI will not be able to cut rates, just not because of the Fed. It's got to be more focused on domestic growth and inflation fundamentals. Also, at the same time, what we are telling clients is that if inflation is at 4.5%, which is what our base case is, RBI could still cut if you get growth somewhere closer to 6%, i.e. that it dips meaningfully below what RBI believes to be the underlying potential growth. So I think at this point of time, since our base case forecast is that inflation will be going down to about 4.5% sustainably, and growth is going to be 7% this year, it gives little room for RBI to go ahead and cut rates immediately.
Okay. Isn't there a possibility that inflation undershoots even 4.5%? As it is, the Reserve Bank's second quarter forecast is 4.4%. Going by the July-August numbers, it looks like it will not be 4.4%. It will probably be 4% or less than that for the quarter. As well, you have a huge Chinese disinflation, you have crude falling, you have probably a La Nina monsoon. Do you think there is a good chance of undershooting and therefore an opportunity opens up for a cut?
Well, so I think this quarter, if you remember, even RBI was earlier expecting it to be below 4%. Now they've revised it, but we are still at around 4%. So September quarter, definitely inflation will go down to 4%, but that would not be something that RBI can say it's durably down to 4%. We expect, and I think the consensus also expects it to go back up to about 4.5% in the coming quarters after that quarter. So it will be difficult for, I think from that context, RBI to go ahead and cut rates. But if we are wrong and inflation does go down to 4% sustainably, I think that will definitely open up the room for RBI to cut rates. And even if RBI cuts rates, look, we are only talking about a 50 basis points of rate cut. So I don't think there is a lot that interest rates can do now to boost growth.
Okay, Chetan, let's discuss growth as well. What has not been discussed much is that the FOMC dot plot has brought down the GDP forecast a smidge from 2.1 to 2%. It has brought up the unemployment rate rather substantially from the earlier 4% in June to 4.4%. Is there a chance of global growth slowing and that impacting India?
So I think US is on a very strong footing right now. And to the extent to which what we think the Fed has done is try to cut the risk of causing further slowdown out of restrictive monetary policy, it does give us the confidence that the US will be seeing soft landing. And look, right now, the third quarter number, according to Atlanta Fed, is tracking at 3% Q-on-Q. And it would be nearly around 3% on a year-on-year basis. That's a very strong growth rate that the US is going through right now. And in that environment, the Fed is cutting rates. So we are of the view that the US growth will be around, as it decelerates, it will still be around 2%, which is a pretty healthy number. And that will mean that the global growth environment will remain stable. It's not great because Europe is not doing well and China is also not doing well. But to the extent to which what we have as support from the US, that should still be maintained going forward.
Okay. More pointedly about the India story before I come to China. You all recently upped your forecast a bit. Where is that confidence stemming from? I mean, after all, we are seeing unemployment going up in the US and in India as well. If you look at the August numbers, both personal vehicles, PVs, and commercial vehicles, CVs, actually fell. It was only two-wheelers that did well. So why and even PMI manufacturing has peaked off. Though services is doing well. So where is this confidence of upping India's GDP forecast?
Well, so we were a little bit lower than RBI. So we were at 6.8%, and we raised that to 7%. The way we did the math is that, the 6.7% number that we got for the last quarter had some negative effects of the election-related impact on government spending. That was about 20 basis points of shortfall because of that. And agri output was also somewhat weaker considering what's going on in terms of the area under coverage. We think the agri output could also go up. And so you'll get about a 40 basis points increase in growth rates from 6.7 to about 7.1 from the next quarter itself. And so that's what has made us lift our forecast. In terms of the drivers to growth, you are right, you're getting somewhat mixed signals as far as consumption is concerned. We got earlier the development where rural consumption was lagging. Now rural consumption is improving. So I think that's one big factor that is giving us the confidence that the growth recovery is broadening out. And at the same time, if you hear from our industrials analyst about the breadth of CapEx story, there is enough evidence that now private CapEx is also picking up. So we are seeing this broadening of recovery from urban consumption to rural consumption, and from public CapEx to private CapEx. And the best metric is GST numbers. They continue to be pretty robust. If you adjust GST numbers by deflator, GDP deflator, which is running at around 3%, you get a similar number as far as real economic activity is concerned.
Take your point. The RBI is, after all, standing steadfast on its 7.2 number. We will know, of course, in October, when the monetary policy report comes, whether they're changing their mind. But Chetan, I'm going to ask you a couple of unfair questions on the economy, on Indian economy, because I know you don't speak these numbers, but even if you can give me a directional answer. Do you see rupee appreciation? What is the range your team is working with? And yields. Indian yields have tracked the US yields. So even if you think the Reserve Bank is not cutting, we're already at nearly 675 on the 10-year. What is your team telling you in terms of the terminal rate for the 10-year by end of the year or in the next 12 months?
So look, Lata, the framework is what I can share with you. So the framework for INR, what we are highlighting to investors is that if the dollar is weak, INR will underperform because, if you look at real effective exchange rate, it's at the upper end of the band that you would see from a 10-year mean perspective. And we think that in that sense, on a real effective exchange rate basis, rupee has appreciated a lot, and it's a bit on the firmer side. And if the dollar weakens, RBI will intervene and not let the rupee appreciate, just as what we are seeing right now. Actually, a lot of the other regional currencies appreciated a lot, but INR did not. So that would be the approach that we would follow. And if the dollar strengthens, then rupee will outperform because RBI will then correspondingly again intervene to ensure that the rupee doesn't see significant depreciation. So I think that's the framework that we are operating with. As far as rates outlook is concerned, I think that's predicated on our view. The strategists are pegging their view on our view on the policy rates. And that I mentioned, we are not expecting any policy rate cuts from the RBI.
Okay. Well, actually, today the Chinese currency has appreciated decently after the rate cut in the US. So coming to China, India has two worries. One, is this massive Chinese disinflation or disinflationary force in global markets likely to ebb at all? I mean, they're selling steel below cost, according to Tata Steel, $50, $60 below their own cost, as will EVs, solar panels. Is this disinflation likely to ebb at all? And now with the Fed cutting rates, does China have the elbow room to stimulate its economy with a monetary or fiscal stimulus? And therefore, do we get good news out of the Chinese economy?
So I'll answer the first question first, and that will help us to answer the second question as well. As far as the deflation outlook is concerned, the approach that Chinese policymakers are taking is trying to defend their real GDP growth in the context of this massive slowdown in the property sector. by putting in more investment in infrastructure and manufacturing. What they are thinking to themselves is that if you think from the long-term perspective of the country, you have to invest. So while they have a big downturn in demand because of property sector, they're trying to defend it with these two areas of investment. Now that is resulting into excess capacity creation and therefore a bigger deflation problem. And I just recently put out in a report that, when Japan had a similar dynamic weighing on its economy in 1990s, Japan accepted lower real GDP growth. So its growth went down from 5 to 6% to 1%. But what China is doing in terms of defending that real growth and still targeting around 5%, that's resulting into this problem of excess capacities. And therefore, we don't think that the deflation problem in China is going to end anytime soon. In fact, it looks like it's going to be worse than Japan in 1990s. And sorry, Lata, I forgot your second question.
Yeah, will they be able to stimulate because they have now, more elbow room because of the Fed cut? Will China cut?
Yeah, I think it will definitely help. So we are expecting them to take up some more rate cuts and cut reserve ratios, required reserve ratios, but that will be only a marginal help. I think the fundamental problem that China has is that of deflation. And for that, we are recommending that they need to support consumption growth with increase in social welfare spending. They will never do the direct transfers that the US did, but they can definitely increase social welfare spending and support consumption growth. But for that, you don't need really further cut in interest rates. It's just it's a fiscal policy decision that the government has to make.
Fair point, fair point. Just a last, final and a quick answer. Basically, Fed cut positive for Asia?
Sorry, question is?
Fed cut positive for Asia, is it?
It is. It is positive for Asia in the context in which the Fed is cutting rates. Of course, if growth is decelerating hard and Fed is cutting rates, that's not necessarily positive because then the downside from growth will overwhelm the upside from lower rates. But in the current context, and with our base case view that the US will go through soft landing, this is definitely positive for Asia. Because remember, Lata, actually, not India necessarily, but all the other countries in the region, they have their inflation below central bank's target for a number of months now. And they've been holding it back only for the Fed policy response. And so now as the Fed has begun to cut rates, and that too decisively, that gives them the elbow room to cut interest rates and ensure that their growth does not have to be taking a bigger hit.
Okay. Take your points. Thank you very much, Chetan Ahya, for spending time on what must be a busy morning for you and parsing the impact of the Fed's rate cut on India and on Asia, particularly China. Thank you very much for joining us. So with that, it's curtains on Bazaar with the news that the mid-caps are deep in the red, but the bigger indexes are holding up. Let's see how the day pans out. Wrap up on Bazaar. Chartbusters coming up.